Good afternoon, everyone, and welcome to our weekly Daily Mirror Cost of Living Facebook Live, where each week we talk you through all the latest financial updates and money news. My name is Levi Winchester. I'm the money editor here on the Mirror website, and this week I am joined by Bestinvest personal finance analyst. That's Bestinvest personal finance analyst Alice Haine. Thank you so much for joining us, Alice. It's a pleasure to have you.
Thank you for having me on.
So it has been a very busy week in finance. This afternoon, the Bank of England confirmed it has hiked its base rate from 3% to 3.5%. So that's a 0.5 percentage point hike, and it means the base rate remains at a 14-year high. And this comes off the back of the other big news of the week, which is that inflation fell yesterday from 11.1% to 10.7%, still near a 40-year high. Now, the reason I'm mentioning the two together is that they are very much interlinked. The Bank of England is raising its base rate to try and lower inflation. So how does this work? Well, the base rate influences what banks and lenders charge you as their customers to borrow money. So when base rate goes up, borrowing becomes more expensive. So the theory is if interest rates are higher, then people spend less, and then therefore inflation, in theory, should come down. But of course, higher rates of borrowing through raised interest rates is a problem in itself, and it means that all our finances are becoming just that little bit more squeezed at a time when people are already really stretched in the cost of living crisis. So what we are going to focus on today is interest rates and all the things that are happening today, how they affect you, and what you can do about it. So Alice, I'm gonna start by kind of talking about the biggest impact of raising interest rates, which is mortgages. It's the big thing that everyone is obviously talking about. They've been talking about it all year, their mortgage rates going up. So how exactly does the base rate affect your mortgage payment?
Well, we've had a very long period of ultra low interest rates, and it's something that we've probably all got used to. And if you think about it, interest rates actually started dropping around the time of the financial crisis. And, since then, we've enjoyed it. It's been a lovely period of very low interest rates, and you get, great mortgage deals. The situation for mortgages is quite confusing at the moment because there's different ramifications of today's interest rate depending on what type of product you're on. So it's very bad news for those on tracker mortgages. These are directly linked to the Bank of England's base rate. So lenders will typically apply the increase straight away. For people on standard variable rates, and those are mortgages that borrowers can go onto after finishing an introductory fixed, tracker or discounted deals, they could also see that in repayments rise if their lender feeds that increase back to its customers. Not every lender does, but they may do. And again, I mentioned discounted deals there. Again, those are the variable mortgages with a discount on the lender's SVR that some lenders will offer to people for a fixed period. Again, they could see an increase if the lender passes that on. Now, if you've got a fixed rate product, well, you're okay for now, as long as your product isn't expiring anytime soon. So if you are expiring next year, then you're going to be shopping around for a new product. You're going to be looking for a new fixed rate or perhaps a variable rate. And it's not going to be great because you're going to see your repayments jump. The lucky ones in all of this are the people that locked in those longer fixes, like a 5-year mortgage, perhaps in 2020 or 2021. Those products aren't going to expire until 25, 26, so they can really breathe easy at the moment. I would suggest still keeping an eye on mortgage rates and consider the options going forward because, we don't know what's going to happen in 5 or 6 years' time. Anything could happen. Rates could really jump up. And so you still might get a bit of a mortgage shock then. So if you can, I would suggest overpaying if at all possible. Particularly as we're going to go into a period where property prices are going to come down. So lots to think about. But the people that perhaps are the most worried are first-time buyers. They're looking at interest rates, which seem really, really high when you compare them to the past.
Oh, I think we
Year and 5-year fixed
there, Alice.
have been much higher.
Oh, you're back now.
Oh, did I disappear?
Only very, very briefly, but you're back with us now.
Oh, okay. Okay. So for those, if you're shopping for a new product right now, so 2-year and 5-year fixed rate products now sit just below the 6% mark. And that's down from the big high in October when the country was reeling from the mini budget and, you know, rates kind of seemed to escalate out of control. So they're a bit lower than that. And in actual fact, it could be that we've kind of passed the peak of really high mortgage rates because a lot of lenders have priced in the rate increases that we've got coming forward. You know, interest rates are not expected to go up by as much as once feared. You know, at one point, people thought that interest rates were going to go way past the 6% mark. And now we're looking at about 4.5% next year. So lenders have already factored that in. So it could be that if you're shopping around for a new product right now, you're not going to see higher interest rates. We might have already peaked, but there's lots of ifs and buts and maybes here. And ultimately, you know, speak to a broker. A broker is the person who can really guide you through the best options for your situation, because there's different pluses and minuses depending on what type of product you want, how much you owe, etc., etc.
Fantastic. And just because I know we covered a lot of this just briefly then, but just to kind of recap for anyone who might have missed it, if you've got a mortgage that is expiring soon, what should you be doing right now to protect yourself against potential future rate hikes? What would be your kind of tips?
Well, I would say speak to a broker and find out what they can offer. You can lock in a mortgage up to 6 months ahead, sometimes longer actually, depending on the lender, of the product expiring. So really speak to a broker, find out what the options are. They may suggest that don't try and lock in a deal now, or do lock in a deal. They might suggest a variable product. They may suggest a fixed product. There's lots of different options out there. If you've got any spare cash, and that's a bit of a hard thing to find at the moment in this cost of living crisis, look to overpay it. The more that you overpay on that balance and bring that outstanding balance back down, the less your interest payments will actually be. So that's a very good strategy to kind of get ahead of it. But you know, the reality is you are looking at a jump next year. I mean, you know, if we're going to talk about how much more people are going to be paying, then you're looking at, you know, the Bank of England's talking about repayment hikes of about £250 on average for all those people who are going to be refinancing next year. That's £3,000 over the course of a year. That's a big amount. That's something that you've got to try and absorb and be ready for. And the exact amount, it's very much dependent on, you know, on how much your mortgage will rise by. It depends on the size of the mortgage, the rate you fix at, your loan to value when you remortgage. Lots of things to think about then.
No, absolutely. And of course, we all are kind of talking about and are very worried about mortgages at the moment. But what about other debts that you might have? I mean, we talk about borrowing becoming more expensive when the interest rates rise. You know, already we're seeing kind of credit card rates surge to a 16-year high of 30.3%. So what is the kind of impact on the base rate going up and credit cards, loans, all these other sort of types of debts that you may have?
Well, you're exactly right there, Levi. It unfortunately, a higher base rate is not good news for borrowers because it leaves people with less disposable income. It gobbles up their money because you're having to pay more on interest payments. So anyone, the good news here is that anyone with a fixed rate personal or car loan, you know, you're okay. You've agreed the terms of that loan, and the amount that you have to repay is fixed. Your repayments will continue as normal. So you don't need to go into a panic just yet. The issue is for those who are shopping around for new debt. You know, the cost of credit is going to be higher. The cost of your loan is going to be higher. The cost of your credit card will be higher. And we are in the run up to Christmas. This is Christmas time, traditional period of high spending. We want to get lovely presents and et cetera, really, you know, you should try and constrain your spending at this time, because if you're turning to credit to fund those festive celebrations, then you're going to face an uphill battle to pay it off. particularly if you build up too much and that you can't clear it at the end of the month. So it's something that you really need to think about quite wisely, because, as you say, cost of borrowing on a credit card jumped to a 16-year high. And if you're not repaying that balance in full, it's going to be very, very expensive. And really, credit cards aren't the way to go if you've got, if you're not going to be able to clear them. I mean, there are solutions, but they're not ideal.
And is it right that, historically speaking, credit cards are not usually explicitly linked to the base rate, but we're starting to see lenders that are linking it to the base rate? Is that fair to say?
Yeah, I mean, it's not necessarily, it can be a supply and demand issue. Lots of different factors come into it. But unfortunately, at the moment, in the era that we're in, the lenders are kind of linking it more closely. Interest rates are going up and credit card rates are going up. And that's something that, you just have to be aware of. And, if you are going to take on credit, then you've got to do it in quite a carefully managed way and think about how you're going to do it and what you should do if, you get yourself into a situation that you can't get out of.
And what can people be doing right now if they have got credit card debt? What's the best way to tackle that?
If you've got a balance that you can't repay off, I don't know, let's say next month, you've got a credit card balance and you can't repay it within a month, then I think the best suggestion would be to sign up for a 0% balance transfer credit card. And that's where you transfer the debt onto a new provider with no interest applied for a set period. And that can be as long as 34 months. And that's a kind of very good solution. It's the cheapest way to borrow, in fact. But I mean, the challenge here is that lenders are a bit more cautious sometimes about issuing these types of cards. The more generous 0% periods might only apply to somebody with a really good credit rating or who kind of fits their criteria. You've also got to remember there's balance transfer fees. So when you transfer that debt, there will be a balance transfer fee applied, and that is also edging up. So it's good if you can get a really, let's say, you can get a 2-year 0% balance credit card, transfer it over. You won't have any interest applied to that debt for those 2 years. You've just got to make sure you also pay it off in those 2 years, and that at the end of the 2 years, you're not then left with a big debt that you're then going to have the interest rate applied to, and you're going to start paying those interest rate payments again. So that's something to think about. You could also look to consolidate the debt. You could consolidate it into a loan. If you've got lots of different debts, you could consolidate them into one loan with a fixed repayment, so you know exactly how much you've got to pay, when you've got to pay it by, and that takes a lot of the stress if you've got lots of different providers to think about. It kind of removes all of that stress. Just remember that loan rates have also been going up. So again, if you are going to go down that route, lock it in quickly. We are going to see potentially more interest rate rises. So again, get that loan secured now. There's also strategies that you can apply that kind of deal with the mindset of it all, because when you've got lots of debts, it can be quite stressful. It can be quite overwhelming. And so there's these methods that you can apply that can actually help with the kind of mental processing of tackling big debt. So there's something called the debt avalanche and debt snowball methods, and they're great for clearing multiple debts, such as credit cards and loans. And the strategy is that you list all your debts and then you make minimum payments on all of them but one. So you pay off the minimum on all of them, but on one of them, you go heavy on it. And once that card or loan is cleared, you then target the next balance until all the debts are gone. Now, the difference between the two strategies is with the snowball method, you're targeting the smallest debt first. If you've got a credit card with just £300 on it or £200, and you've got 4 others on top of that, clear that £200 credit card off first, close it, then start tackling the next ones. Because each one that you close, it then takes that kind of headache away of worrying about all of the debts. It's less to think about. With the avalanche method, highest interest debt to reduce the overall cost of your liabilities. So, and that again, you go for the highest interest rate one first, pay that off, then go to the next, and it's the same way. So it's kind of applying strategies to your debts to help you along with the process of it, because debt is really overwhelming. And at the end of the day, if you are in trouble, don't put your head in your sand. Don't, talk to your providers. People, they will help you. They can, they might be able to offer you better repayment terms. They may give you a repayment holiday. It's in the interest of lenders to support people who are in trouble, particularly in these times. They know all the cost pressures we're under. We're all facing the same problems. They will help you. If you ignore them and you get yourself into real trouble, then you can go and speak to organizations such as Citizens Advice. There's the Debt Advice Foundation, Step Change, different charities that will kind of help you structure your repayments. They might even liaise with your lenders or providers on your behalf, different ways of and help you through the process, because some people it gets too much.
No, absolutely. And I think worth mentioning on that note as well, that obviously this time of year is really hard. Like you said earlier, it's Christmas. People do have a tendency to want to overspend, but it's really important to go through your finances, make a budget and stick to it. Don't get yourself into debt just for the sake of Christmas, because it's really not worth that financial hangover in the new year, especially as you put, Alice, like everything is getting more expensive, borrowing's more expensive. It's not worth putting yourself in that situation right now. So what
Absolutely not. If you think about it, Levi, if you look back over your last 20 or 30 years, think about all your Christmases and how many of them do you associate with a particular gift that someone gave you? You actually probably don't. You think about the people that were there, the food that was eaten, Uncle Sid tripping over the turkey. You're not thinking about different things, different gifts that people give you. You probably can't even remember what half of those are. So don't put too much emphasis on the financial side of gifting. It's more about getting people together. That's what the beauty of Christmas is.
No, completely agree, Alice, and couldn't have put it better myself. So now what I'd like to come on to next is the good side of interest rates rising, which is that savings rates are slowly creeping up too. Although I should add that the best deals are still painfully below the rate of inflation, but needless, they are still going up for the first time in what feels like a very, very long time. So, Alice, would you like to talk us through what has been happening to saving products this year, what with all the kind of consecutive rate rises?
Yeah, so we have seen a rapid rise in savings rates over the course of the year, and that's because interest rates have been going up since December last year. We've had 9 interest rate rises since December last year. So it should feed into savings rates, and it has done, thankfully. We are seeing more people depositing more money because they're looking to cash in on that. They're finally getting some kind of return, not an inflation beating return. The return is still deeply negative, but they are, the money is there's something happening rather than nothing. So, you've got much higher rates of about 2.85% for an easy access account, about 4.8% for a fixed rate account, 7% for a regular saver. There's products like that around. You just obviously at the back of your mind, you've just got to be aware of the inflation factor. But the good news is that inflation, it could be that we've passed the peak, and it could be that inflation drops down much further next year. That's what the Bank of England is saying. You can never be sure. We've had lots of economic shocks over the past few years that have changed the situation quite dramatically. But in theory, inflation should go down. And so really, if you're getting a fixed rate deal or a good savings product now, it really does make sense, because although your return is deeply negative at the moment, over time, we're going to see pay growth and inflation, the gap between pay growth and inflation narrow. And it just means that, your savings will be working more effectively for you. So the other thing to think about is that the pace of savings rate rises appears to be easing. So some of the really high deals that we saw were kind of in the wake of the mini budget. Some of those are being withdrawn, and that's because interest rate expectations and inflation rate expectations are lowering. So, you can get good rates out there, but be quick. You want to make sure you snap up these deals before they go, because, you don't know how long they're going to be around for.
And are banks and building societies passing on these base rate increases, or are some of them being a little bit slow in doing this?
pass on interest rate rises onto savings accounts. And that's very different to the other way around, where lenders are traditionally quite fast at applying interest hikes to debt payments. But basically, I mean, the message is the same: is if you don't switch your money to a high interest savings account quickly, then you're losing out, because there are still a lot of accounts that are on these really kind of ultra low savings rates, and they're hangovers from before the interest rate rises began. And if you've got money sitting in there, it could be doing absolutely nothing. It might still be at 0.1%. So it's really in your interest to move it, particularly when you consider the kind of corrosive effects of inflation at the moment. And the other thing to really think about as well is with savings, is that you don't want to be putting too much in to all your savings accounts, because you've got to be aware of the tax factor. With now that we've got much better interest rates, you could actually be at risk of busting your personal savings allowance, which is £1,000 if you're a basic rate taxpayer, and £500 for a higher rate taxpayer on 40%. And then for the additional rate taxpayer, they don't actually have any concession at all. So you don't want to earn too much interest on your savings, because then you're going to face a tax bill. So then you might want to think about something like a cash ISA or an investment ISA, because they're tax wrappers that protect your savings from the effects of tax. So that's something to consider about as well. But yes, banks do pass them on. They're a bit slow, but just remember that some accounts haven't moved, so you want to make sure that if your money is sitting in one of those accounts, that you're shopping around for a better deal.
And I think you made a really good point there, Alice, as well, where you said your money has to go somewhere, so make the most of these good offers and jump on them while you can. One thing I was going to ask you was, should people be fixing for a long time at the moment? Because obviously, longer the fix is in your savings account, the higher rates you're going to get. But then is there a possibility that you might miss out on future rate rises because your cash is locked away?
There is that risk. The feeling is that the kind of the better rates might have already gone. But obviously, as I say, when you're kind of looking at financials, there's never any guarantee. We've had war in Ukraine, we've had COVID, we've had all kinds of challenges, we've had a mini budget, so you just don't know what's going to come next. So it could be that savings rates go up again, and it could be that they don't. So whatever you do, even a 1-year fix would a good 1-year fix makes sense, because with inflation coming down. But it just depends whether you like to think, okay, I've got this rate and it's secure. So it could be that if rates are now going to come down, savings rates, then fixing now for a longer period does make sense, because you'll get that nice return for a longer period of time. But no guarantees.
No, of course. And I think obviously very, very important to remember as well that no one has a crystal ball. No one can be sure how the next year is going to pan out. I think people certainly wouldn't have been able to guess what we've experienced the last year, certainly. So just because I'm aware, obviously, of time is sort of slowly passing us by, so just wanted to kind of sort of start to wrap up and ask you, what else could people do now to combat rising interest rates? What would be your top points?
I think the key thing is you need to get a grip on your finances. If you think about it, if your mortgage payments are low and you've got no debt and you've got money to save, then higher interest rates aren't actually a bad thing. It's not going to affect your day-to-day life. So really, the kind of key message here is you've got to live within your means and not build up debt. That's the kind of secret to beating interest rate rises. So overpaying on your mortgage, you can overpay up to 10% of the mortgage balance. This will reduce the debt. It'll also reduce your monthly payments, and you won't pay interest on the money that you overpay. At the same time, you want to be building up your savings and reducing your debts. If you live within your means, then you're holding on to more of your money. And that's money that you can then direct to your savings, paying off your mortgage, boosting your investments. It's really a case of getting a grip on your finances. And this comes down to the basics of personal finance, which is to build a kind of a budget. and this is a really good time to do it. We're coming up to the end of 2022. We're going into 2023. Everyone's talking about big challenges ahead. So be ready. It can be as simple as writing down your outgoings on a piece of paper, knowing exactly how much money you need to pay for your vital bills, your rent, your mortgage costs, your utility bills, council tax, insurance, food, commuting, phone, broadband, car, you name it. Savings and investments, make sure that's in your budget as well. And you also want to think about the things that you like to spend on, like holidays, subscriptions, gym memberships, going out. Add all that up. What do you get? Is it less than your net income? And that's the amount that you take home every month. If it is, well, then try and make it even, push it down even more. So you've got more money to pay off that mortgage, pay off the debts, and save. And if you're living beyond your means, then you just need to do a full kind of audit of your finances. Why are you living beyond your means? What can you slash out? You've got to be kind of quite dramatic and just slash things out. I don't need that. I don't need that. Only pay for what you need to. Cut everything you possibly can. And these are lessons that won't just serve you well for now. They'll serve you well for the long term. And at the same time, just make sure that as well as keeping on top of your expenditure, that you're boosting your savings and thinking for the long term. You want to be thinking about your pension. You want to be making sure that when you retire, that you're not going to be phased by interest rate rises, because you've built up a really robust pension that's going to support you through, those years when you're not working. And the great thing about pension saving is it's the most tax efficient way of saving money, because you get a lovely little tax relief on the contributions that you make. So in actual, although if you pile more money into your pension, you can't access it till you retire, it still means that when you do retire, you've got that lovely financial net to protect you all through those later years. And interest rate rises won't phase you if you're that, if you're financially if you're financially robust, then interest rate rises aren't going to be a problem.
No, absolutely, Alice. And again, really good tips, not just for today, but obviously to see you through the next few years and into your retirement as well. So that's absolutely fantastic. So I think that is just about all we have time for today. As I said, a very, very busy week in the world of finance.
Oh, well, thank you so much for having me.
You're very welcome, Asa. You've been an absolute pleasure to have with us.
Absolutely. Well, thank you very much for having me.
Pleasure. So we won't be back now until the new year, when we will be here again with another Daily Mirror Cost of Living Facebook Live special. So have a very Merry Christmas all and a wonderful new year.